If you are over 66 and receiving any kind of payment from the DWP, whether that is your state pension, pension credit, housing benefit, or any other support, then what I am about to tell you in the next few minutes could be one of the most important things you hear this year. Because right now, the DWP is quietly running checks on millions of pensioner records across the United Kingdom. And the people being caught out are not fraudsters. They are not criminals. They are ordinary, decent people, people just like you, who simply did not realize that something in their financial life had changed and that they were supposed to tell the DWP about it. The consequences of those missed notifications can be serious. We are talking about overpayment demands running into thousands of pounds. We are talking about benefit suspensions. And in some cases, we are talking about formal investigation letters arriving through your letterbox with very little warning. Now, before you turn this video off thinking, that won't happen to me, I want you to stay with me. Because the single most common thing people say after they receive one of these letters is exactly that. I had no idea I needed to tell them. I thought what I had was fine. That is precisely why I made this video today. Not to frighten you, but to make sure you have the chance to check your own situation before the DWP checks it for you. And trust me, you want to be the one who finds any issue first. We are going to go through exactly what the DWP is looking at, why the rules have tightened considerably in 2025 and 2026, what kinds of changes in your life you are legally required to report, and what you should do right now to protect your pension and your benefits. I will also walk through 5 real-life situations that show exactly how ordinary pensioners have been caught out, so you can see whether any of those situations sound familiar. Stay with me, because the most important part of this video, the practical steps you can take today, comes later on. And for many people watching, that section alone will be well worth the next few minutes of your time. Let us start by understanding why this matters so much right now, in 2026, more than it perhaps ever has before. The DWP, the Department for Work and Pensions, has been given significant additional resources in recent years, specifically to tackle what the government calls benefit overpayments. In their own figures, the DWP has identified billions of pounds in overpayments across the benefit system, and a substantial portion of that sits within the pensioner population. Now, it is crucial to understand something. The DWP does not only investigate fraud, the system also flags what are called official errors and, more commonly, claimant errors. A claimant error simply means that you, the person receiving the benefit, either gave incorrect information at some point or you failed to report a change in your circumstances that should have been reported. And here is where the problem really begins for pensioners over 66. Many people in this age group reached retirement before the modern digital reporting systems were in place. They filled in a form years ago, they started receiving their payments, and they assumed, quite reasonably, that unless something dramatic changed, they did not need to do anything further. For a long time, that approach broadly worked, but the rules around what you must report have always been stricter than most people realize. And in recent years, the DWP has increasingly been using data matching technology, cross-referencing their records against information held by HMRC, banks, local councils, the land registry, and other government departments to identify discrepancies automatically. What this means in practice is that the DWP may already know about a change in your circumstances before you have told them. And if their records show that your financial situation changed months or even years ago, and you did not report it, they can, and often do, seek to recover the money they consider to have been overpaid during that entire period. That is not a small number in many cases. If someone has been receiving pension credit, for example, at a rate that should have been lower because their savings increased or they received an inheritance, the DWP can calculate the overpayment going back to when the change occurred. And for some pensioners, that figure has run to several thousand pounds. The important detail here, the one that catches most people off guard, is coming up in just a moment. Most pensioners over 66 who find themselves in difficulty with the DWP are not people who did anything dishonest. The real issue is not fraud. It is a genuine, widespread misunderstanding about what reporting a change actually means. People tend to think of a change in circumstances as something dramatic. Moving house, getting married, a spouse passing away. And yes, those things absolutely must be reported. But the list of changes the DWP expects to be told about goes much further than most people imagine. Here are some of the changes that are commonly missed and that the DWP actively looks for. If your savings go above a certain threshold, currently £10,000 for pension credit purposes, that can affect the amount you are entitled to receive. Many pensioners do not realize that savings includes not just cash in a bank account, but also premium bonds, stocks, and shares, and in some cases the value of certain financial products. If your savings increased because you received a gift of money from a family member, or because you sold something of value, you may have needed to report that. If you began receiving any additional income, perhaps from renting out a room in your home, or from a small private pension that you deferred and then started taking, or even from a foreign pension, that income is relevant to your benefit entitlement and must be reported. If someone moved into your home and began contributing to the household costs, that may affect your housing benefit or council tax reduction. If you spent time abroad for longer than the allowed period, that can affect your entitlement. If your partner's income or savings changed, that matters too. The reason so many people miss these reporting obligations is not carelessness. It is that when people set up their benefits, they are often not given clear, plain English guidance about every single trigger that requires a new notification, and the circumstances of life. An aging parent leaving a small inheritance, a grandchild helping out financially, a small investment that grew quietly over the years, do not feel like changes that need reporting to a government department. But in the eyes of the DWP, they very much do. And this is where many retirees get caught out. Let me walk you through 5 situations that illustrate exactly how this plays out in real life. None of these are designed to alarm you unnecessarily. They are based on the kinds of circumstances that arise regularly, and they are here to help you recognize whether anything similar applies to you. The first situation involves a widow receiving pension credit. Margaret is 74 years old and lives alone in a terraced house in Yorkshire. When her husband passed away 4 years ago, she applied for pension credit and was awarded it. What she did not fully appreciate was that her husband had a small life insurance policy. The payout, around £18,000, was deposited into her savings account. Margaret was grieving, she was overwhelmed with paperwork, and reporting this money to the DWP was simply not something she thought about. She assumed it was a personal family matter, not something connected to her benefits. 2 years later, she received a letter. The DWP's data matching systems had cross-referenced her bank records and identified the savings increase. The overpayment they calculated ran to over £3,000, and she was required to repay it in installments. Margaret had not done anything wrong intentionally, but the obligation to report had been there from the beginning. The second situation involves a pensioner with a rented room. Derek is 68 and lives in a semi-detached house in the Midlands. His adult son moved back home following a relationship breakdown and began paying Derek £300 per month towards household costs. Derek did not think of this as income in the formal sense. It was just his son helping out. But that regular contribution was, in the DWP's assessment, additional income that should have been declared. When his housing benefit was reviewed, the discrepancy was identified. Derek had to repay a portion of the housing benefit he had received during the period his son was contributing. The third situation involves premium bonds. Patricia is 71 and had always saved carefully throughout her working life. She received pension credit and had declared her savings accurately when she applied. Over the following years, she gradually added to her premium bonds, small amounts here and there, gifts from birthdays, a little from her monthly budget. She did not think of this as a change because the additions were modest each time. But over 3 years, her total savings, including the premium bonds, crossed the £10,000 threshold that affects pension credit calculations. She had never reported this because she had never thought of it as a single event requiring reporting. It crept up gradually. The DWP's review identified the issue, and she found herself facing a repayment demand for the difference in what her pension credit should have been. The fourth situation involves a small inherited property abroad. George is 70 and his parents came to the United Kingdom from Cyprus many decades ago. When his elderly mother passed away, George inherited a small share of a family property in Cyprus. He was not receiving rental income from it. It was not generating money. But under the rules that apply to certain means-tested benefits, the capital value of assets, including property held abroad in some circumstances, may be relevant to entitlement calculations. George had simply not known this. He had never been told, and it had never occurred to him that an overseas family property he had never visited would have any bearing on his UK benefits. What happens next in cases like George's can vary significantly depending on circumstances, but the key point is that it should have been disclosed, and it was not. The fifth situation involves a private pension that was deferred. Susan is 67 and had worked for a local council in her 50s. When she left, she had a small defined benefit pension that she chose to defer, intending to take it later. When she reached 66, she began claiming pension credit. The following year, she decided to activate her deferred council pension, which added approximately £80 per month to her income. Susan knew she now had this extra money, but she did not realize she was required to tell the DWP about it promptly. She assumed it would come out in her annual review. In many cases, however, the obligation is to report a change when it happens, not to wait for a review. The delay between when she started receiving the pension and when it was picked up in her records led to an overpayment that she then had to address. Each of these situations is different, but they all share the same underlying pattern. A change happened, the DWP was not told immediately, and the financial consequences followed later. In every case, the individual involved genuinely believed they were doing nothing wrong. It is worth taking a moment to understand why the DWP takes reporting obligations so seriously, because understanding their perspective can help you see why acting promptly is so important. The DWP administers a benefit system that pays out hundreds of billions of pounds every year. The means-tested elements of that system, pension credit, housing benefit, council tax reduction, and others, are specifically designed to support people who have limited income and savings. The entire system is built on the premise that the information provided to the DWP is accurate and up to date. When circumstances change and the DWP is not told, it continues paying out at the previously agreed rate. Over weeks, months, and sometimes years, this creates an overpayment. The DWP's position, backed by law, is that if they have paid out more than someone was entitled to receive, they are legally entitled to recover that money. In the vast majority of cases, this is handled through deductions from future benefit payments, which softens the immediate impact. But the obligation to repay remains. HMRC plays an important role here too, because they hold records of income, employment income, pension income, savings interest, and other financial data. The DWP's data matching arrangements with HMRC mean that information you may have reported to HMRC but not to the DWP can surface during a review. Banks and building societies are increasingly required to share information in certain circumstances as well. While the specific triggers for this are complex and depend on the type of account and the nature of any investigation, The broad direction of travel is clear. The government has more access to financial data than it did even 5 years ago, and that access is increasing. For pensioners, the key message from all of this is straightforward. The system is becoming more joined up, not less. Hoping that a change will go unnoticed is not a safe strategy. Reporting proactively and promptly is always the better approach. Now let us turn to what you can actually do. Because the good news, and there genuinely is good news, is that if you take action before the DWP contacts you, the outcome in most cases is far better than if they come to you first. Here are the practical steps I would encourage every pensioner over 66 to take right now. The first step is to gather a clear picture of your current financial situation. Write down or ask someone to help you write down every source of income you currently receive. That includes your state pension, any private or workplace pensions, any savings interest, any rental income, and any regular payments from family members towards household costs. Then, list your savings, including bank accounts, premium bonds, ISAs, and any financial products you hold. Be thorough and honest with yourself. This is not about judgment. It is about having an accurate record. The second step is to compare what you have now with what you declared when you last updated the DWP. If you are not sure what you declared, you can contact the DWP and ask for a copy of your claim details. The Pension Credit Helpline, which you can find on the gov.uk website, can help with this. You are entitled to ask what information they hold about you. The third step is to identify any changes that have occurred since you last updated your claim. Has your savings balance increased significantly? Have you started receiving any new income? Has anyone moved into or out of your home? Has your marital or partnership status changed? Has a bereavement resulted in an inheritance? If the answer to any of these questions is yes, and you have not already reported it, that is something you need to address. The fourth step is to report proactively. If you identify a change that should have been reported and was not, contacting the DWP yourself, before they contact you, is almost always treated more favorably than being discovered through a data matching exercise. Voluntary disclosure is viewed differently from a situation where the DWP finds the discrepancy independently. Rules can change and outcomes vary depending on circumstances, but in many cases, proactive disclosure can lead to a more manageable repayment arrangement. The fifth step is to seek independent advice if you are at all unsure. Organizations such as Citizens Advice, Age UK, and your local council's welfare benefits team can provide free guidance on what you are required to report and what your rights are. A pension specialist or benefits advisor can also help you understand your specific entitlement in light of your current circumstances. It is always better to ask than to assume. If you have already received a letter from the DWP about an overpayment, or if you are currently under review, I want you to take a breath and stay calm. It can be very frightening to receive a letter like that, particularly if it is unexpected. But panicking will not help, and there are clear, practical steps you can take. First, read the letter carefully. Understand what the DWP is saying they believe has happened. Check the figures they are quoting and the time period they are referring to. Letters from the DWP can sometimes be confusing, so if you are unsure what it means, do not guess. Get help to understand it. Second, do not ignore it. Ignoring correspondence from the DWP will not make the situation go away. It will, in most cases, make things worse. Even if you disagree with what the letter says, you need to respond within the timescale they have given you. Third, if you believe the DWP has made an error, whether in the calculation of any overpayment or in the underlying facts they are relying on, you have the right to challenge their decision. This is called requesting a mandatory reconsideration, and it must typically be done within 1 month of the date of the decision letter. Citizens Advice or a welfare rights advisor can help you with this process. Fourth, if the DWP has correctly identified an overpayment and you accept that, you can discuss a repayment plan that is affordable for you. In many cases, repayments are deducted from your ongoing benefit payments at a rate that takes your financial circumstances into account. You do not necessarily have to repay a large sum all at once. It is important to check what options are available to you in your specific situation. Fifth, regardless of how the current situation is resolved, use it as an opportunity to put a regular review process in place going forward. Once a year, go through your income, your savings, and your living arrangements, and check whether anything has changed that the DWP should know about. Making this a habit will significantly reduce the risk of anything similar happening again. Let me bring this together, because there is a single, clear lesson running through everything we have covered today. The DWP's systems are more capable than ever of identifying discrepancies between what pensioners have reported and what their financial records actually show. The changes that matter are not always dramatic or obvious. They can be gradual savings increases, a small inheritance, a deferred pension that finally gets activated, or a family member contributing to the household. Each of these can affect benefit entitlement, and each of these carries a reporting obligation that many pensioners simply do not know about. The warning I want to leave you with is this: the time to check your situation is now, today, or this week, not after a letter arrives. If everything is in order, you will have peace of mind. If something has changed that you have not yet reported, you will have the opportunity to address it on your own terms, in a way that is far more manageable than waiting for the DWP to raise it with you. You have worked hard for your retirement. You deserve to enjoy it without financial worry or the stress of unexpected demands. A little time spent checking now could save you a very great deal of difficulty later. If you found this video helpful, I would be very grateful if you would click the subscribe button below. On this channel, we cover everything that matters to UK pensioners, from state pension updates and DWP changes to HMRC rules, savings advice, and retirement income. We explain it all in plain English without jargon so that you always know exactly where you stand. New videos go up regularly, and every one of them is designed to help you protect your income, understand your rights, and make the most of your retirement. We are glad you are here, and we will see you in the next one.